Good morning, Richard Calhoun, real estate broker with Creekside Realty, here to discuss the Silicon Valley real estate market week number 6. We'll jump right into it. We'll come back to this slide at the end. What we're going to be talking about is Silicon Valley initially, and that's 3 counties, Santa Clara County, San Mateo County, and Alameda County. That's on slides 2 through 63. We're then going to be talking about the Greater Bay Area, which includes these other 10 counties that I have in a total of 5 groups: Silicon Valley, San Francisco, North Bay, Central Valley, and Central Coast. We're talking about single family homes only. We're talking about a 5-week reference period, and we're using 2014 through 2023 for a 10-year moving average. To me, this is the big story that I don't hear anybody talking about, and we're going to see a little contradictory information, I think just even on the next slide, where it looks like the market's really improving. What you have to look at is real estate is very cyclic, which is why I do this week comparison and a 5-week comparison and year comparing the same days every year, is because of the strong cyclic pattern to it, seasonal cycle pattern. What I want to point out here is this is the number of volume of transactions, and we're having record low number of, and actually we're having record low number of closed transactions, but this is based on number of offers accepted that are still successful. So they will eventually close because I keep taking out the TFTs. But this year, 2023, we started off the year with 997 transactions. We got down to a low of 806, and now we're up to 1,296. If you go from 800 to 1,300, you've basically improved by 500. That's more than 50% improvement in just a matter of 5 weeks. But what I want to point out is you were only 85% of your previous record. You were 15% below your previous record. Now, in the recent weeks where people are starting to perceive the market's coming to life, we're a full 20% below our previous record low. Just for reference, the reference low year was 2008, which was after the mortgage meltdown, but before the stock market meltdown. And then this is the lowest number of offers we've had in 25 years, so you can see what it is. And then for those that are curious, in the last 10 years, the last 10 years have been better than 2008. So this is a slide that now would contradict, because if you look at this, you see a lot of red, and red basically indicates a strong marketplace. And it is strong. And the reason, and this is based on days of unsold inventory, how long would it take to sell the existing inventory? The reason it's so red is because the buyers tend to come out of the woodwork sooner than the sellers. So you've just come through the holidays with no inventory, and now the buyers are coming out trying to buy property, and there's no property to buy, so what's available to purchase sells right away. And that's why we typically have price increases starting about this time of the year. And, everything looks like it's set to go to the races. But what you have to do is compare this, what appears to be a red hot seller's marketplace, to where we normally are. And we'll get to that in a little bit. Now I've added a slide, and I've added a couple slides this week, and I think they're pretty beneficial. This is looking at the 75th percentile on time on the marketplace, not the median that we've been talking about before, that a lot of people talk about, not the average, but sort of the long typical seller, the seller that's on the market for 75% of the length of the seller. So 25% of the sellers take longer, 75% of the sellers sell quicker than this time frame. Now, Cupertino, if you're in Cupertino, that's going to be really hot, because 3/4 of your sellers are selling in under 2 weeks. In Milpitas, North Valley, Berryessa, as well as Santa Teresa, Blossom Valley, there 3/4 of the people are selling in just over 2 weeks. So, it's a pretty aggressive market. Same with Union City and Newark, the same with Foster City. Now, Foster City happens to be a very small micro marketplace, but this gives you an idea of time on the market. So real quickly, you can see the coast is very slow compared to everybody else. And what's that? 70 days. So 25% of the sellers are taking longer than 70 days. 75% of the sellers are selling quicker than 70 days. That, gives you a little bit of a benchmark that's easier to understand. You can see Pleasanton out here in the Livermore area is a little bit slower than the Livermore Dublin, probably because of affordability. Now we're moving on to ask price reductions. This is also a new slide. This shows how much the sellers have reduced their asking price at the time the offer is accepted. The concept here is to try to get an early benchmark on what's happening with prices. If the sellers are taking price reductions, that indicates a softer marketplace, and we don't have to wait for escrow to close. This is between the original ask price and the list price at the time the offer is accepted. Same concept. If you're red, you're a hot marketplace, like right here, Foster City. Average price actually increased by 0.4%. It's probably one person increasing it. So it's going to be very rare that these numbers are over 100%. And you can see that the amount of decrease is fairly small. 99 even looks like it's white in color. Anything below is slightly blue in color. Anything above is slightly red in color. And again, it gives you an indication. So one of the slowest marketplaces is Saratoga, Los Gatos, where those sellers are taking a 3% price reduction by the time they accept their offer. Now we go back to one of my standbys, and this is the overbidding. And less than a year ago, basically April of 2022, we were selling homes at 118% of their asking price. That was on average. Now these numbers are basically all below 100. And I did actually look into it. Oakland is accurate data, and it's almost surprising in a lot of ways at 103% because it's got a lot of days of unsold inventory. I think it has almost 90 days of unsold inventory. You wouldn't expect overbidding. And I did actually dive into it this morning. And what it turns out to be is there's a certain segment of Oakland, most likely. I didn't get down and look at actually where the properties were located, but there's a certain percentage of the properties in Oakland that come on the market and they're selling for consistently about 25% above asking price. Those people selling above 25% above balance out the ones that are selling below. That's one of the reasons why when you look at statistics and you just get a number, it doesn't necessarily tell you what's going on. But this is accurate data. I thought maybe since it was, always stuck out as odd ever since I added it, I thought there might be something wrong with my formulas, but not the case. This is the frequency of overbidding. And here across the board, you can see it's not common for sellers to get more than their asking price. Now, some people might say that even getting a third of your sellers more than their asking price is pretty fantastic. And in that case, most of the market would be, a fantastic marketplace. You can see a lot of these are somewhere right around a third. And basically from a third to half the sellers getting more than their asking price is when it's white. So the bulk of Santa Clara County is the area where, people are basically getting a little bit of their asking price, a third to a half. And the blue are below a third. So you can see the North Santa Clara County, Southern San Mateo County is getting less, South Santa Clara County, the Pleasanton area, and I guess that would be Union City in Newark, and Union City in Alameda County is getting quite a bit less. And by quite a bit less, closer to 20%. But still, that means 1 out of 5 sellers are getting more than their asking price. This is also a new graph. And this data, just for absolute clarity, is 1 day old. And that's because I got it up working and then it blew up on me when I processed the data from midnight last night. But what this slide is, and it's a slightly different slide, I went back and looked at my data. I had been measuring appreciation since 2020, and then I went back and started measuring it from April 1st of 2015 through March 31st of 2016. I'm now pretty confident that I'm going to set the benchmark of being April 1st of 2015 through December 31st, 2015. So the last 3 quarters of 2015. And the reason for that is in early 2016, prices started going up, and then it starts getting an equation of, which area had a bigger percentage of the transactions in 2016. By keeping it to 2015, I end up with a very stable base, and I don't have that fluctuation. This shows you the appreciation. Cupertino is showing 0 because I had a problem with Cupertino that I fixed that I think blew up everybody else. 0 is just a placeholder, but the big takeaways is Oakland down here at 120%, Foster City at only 118%, San Mateo Coast at only 120%, Los Altos, Palo Alto at 120%. A lot of the areas are only at 120%, which is 20% appreciation since the last 9 months of 2015. But then others are up here, like East San Jose is at 75%. I think East San Jose stands out in my mind because it probably, in 2015, it was slow to recover from the 2007-8 mortgage meltdowns. And therefore, it was depressed probably in the time frame of my metric, which brought it up. But then, right on its heels is Santa Teresa, Blossom Valley. And then on the other flip side, the expense is 168% in Atherton, Menlo Park, Union City, and Newark. I would basically say in the well-performing areas, they've had 2/3 of their percent of property appreciated since 2015. The underperforming areas are only went up by about a fifth, 20%. Here's your sold price in the different areas, and you can see Cupertino is showing up as straight zeros. And again, I should get that fixed by next week. The low number is the 10 percentile number, the middle is the median, and the high is the most expensive you expect in the other area. They're all together. They're all integrated on one color scheme, which I think is the way to go. You can see that the Redwood City is still more expensive than the Bay Cities on the median. Redwood City down here is just a slightly darker red than up here. I can't tell the difference, but it should be a little tiny bit redder. So now instead of looking at just 1 week, we're looking over time. And this is where things start looking not so good. This is inventory, so this is actually positive, and this is one reason days of unsold inventory is so low. You'd expect inventory to be up here at the tail end of that light gray line, and instead we're down here. The least inventory we had is down here at the red line. Even though we're having very few sales, we have very few sellers. I think what's happening, and this is just speculation because there's no way to know motivations of sellers that aren't on the marketplace, is sellers have seen that the property values have dropped by 20%, 30%, maybe a little bit more, maybe a little bit less, depending on the area. And they're saying, why will we sell now? And so the sellers are staying off the market. I believe that is only going to last for so long before family needs and other things other than strictly an investment aspect are going to come into play, and sellers are going to start coming on the marketplace. Right now we have very limited sales, but we also have very limited inventory, so the market's staying somewhat in balance. Here is where the negative news starts really showing up. The purple is the current data. The worst year we've ever had is way up here. We should be selling something like 1,700 homes, and in fact what we're doing is we're selling something like maybe 1,250. So there's a huge discrepancy. Where you'd expect the market to be is way up here at 2,000. So we're, what is that, 40% below where you'd expect it to be. And then our best year was up here at something like about 2,200 homes being sold in the past 5 weeks. And this is over a 10-year period of time, so it's pretty stable. You can see going in the back, the 10-year pattern repeats. So when you see these lines, when the purple shades a line and you can't see it, just go back 1 year. I've also made the annual lines darker and the quarter lines faint, so you can quickly see the annual cycle. I thought that was better than keeping them all the same uniform thickness. Here's an example where I marked the blue line because I thought people might be curious. It's right there where the line points, even though the arrow's pointing away from the data, is where the coolest you've ever had. So days of unsold inventory, one of the coolest marketplaces we've ever had in the last 10 years would have been just about 40.5 days. Right now, we're probably about 38 days. It's not dramatically different, even though 38 days sounds like an aggressively low days of unsold inventory, and it is. You have to put it in perspective. At this time of the year, it's normally very low. The median is down here normally around 30. We're quite a bit higher than where you typically expect to be, and our best year we were down sub 20. Same concept, days on market. This is the median days on market. The coolest dot is right underneath here. You can come back 1 year and see the heights and be very similar, which is why you're not seeing it. You can see it going in, going up, and then it gets covered over. So you'd expect the market to be down here somewhere around 16 days, and instead the market's somewhere up here around 22. Yeah, 22 days on the market for the typical seller is a fantastic marketplace, don't get me wrong, but when you're used to being down at 16, the market's not as hot as it may really seem like initially. Here's my 75 days on the market, and you can see the difference there. Here's the hottest we've been. Here's where you'd expect the market to be, and the data's right on top of the blue. You can see, just go back 1 year, the two are on top of one another, and you can also see the purple does look like it's rolling over as you'd expect. Pretty soon, I'd expect this to start coming down as the properties that are coming on the market since the first of the years are more and more of what's selling. Here's the largest percentage decrease on asking price. So I took the 10 percentile that had the biggest price reductions and plotted that. So the coolest we've been in the past is up here somewhere around 94%. Sellers were taking a 6% reduction, and this is over their asking price. So this is how much they've reduced their own asking price. And right now we're down here at something like 92.75 or something of that order. Again, you can see that we've improved dramatically, but there's this huge cycle that improves every year. And that's the kind of thing that I think is real important to understand is the market is clearly improving, but it's still not performing well for the where you'd expect it to be based on where we are on the calendar. Here's the average asking price reduction. So this is the list price. So the previous was the one that took the biggest 10% discount. This is everybody in an average. That's why you're up here over 100%, which is pretty rare. Basically, it said that enough listing agents were raising their price when they got offers above asking to not have that situation for the appraiser. I don't think it matters, but some people disagree with me, and that's what makes the world go round. So right now you're down here. So on average, the discount's about 1.5%. Sellers getting 98.5%. But this is their original ask price to the list price at the time the offer is accepted, or the list price at the time the offer is accepted to the original asking price, and that's why it's down. So again, sellers are taking a bigger drop right now than you'd expect them to based on the past performance. Here's the magnitude, and again, you can see you're down below 100%, which doesn't happen very often, but we're below 100%, but we're way below the blue line, which is the coolest we've ever been. And you can just see that historically. The only time you were down at all is down here, and you were only down maybe 1/4%. And here you're down a full, well, maybe that's 0.5%. Here you're down a full almost 2%. There's a big difference. Again, the market's improving. Someone's watching and saying, hey, the market's going up because the discounts are less. Yeah, that's technically true, but you'd expect them to be going up this time of the year. So is it any difference? Everybody has their own opinion. That's what makes the world go round. So this is the average between the overbidding. So this is the difference between the sale price and the list price. So this is where we come into needing escrows to close, and we have a time lag. These are very similar. This is the median overbidding. This is the average overbidding. So this lets you know what the typical seller is doing. So the typical seller is getting below their asking price, and here your average seller is getting almost their asking price because the ones above are pulling the ones below up because people tend to go higher up. There's no cap on up, and prices are very sensitive in the downward direction. That's the difference. This is the average. The previous was the median. This is the frequency of overbidding. How common is overbidding? And again, you can see overbidding is becoming more common, but it's far less common than you'd expect it to be. The worst you'd expect it to be is a little bit north of 40%, and here we are a little bit south of 40%, maybe at 35%. You'd really expect it on the typical year to be up here almost at 60%, call it about 57%. And on the hot years, we were up here around 75%. And you can see that we peaked up here around 85. And this is for all three counties. When you look at just Silicon Valley, it peaked up, I believe, at over 90% and was getting, I think, 124%, because I think it was the average of the three counties. It was 18% up. Here's the price over time. So for all three counties, so you can see that we've come back down to about where we were at the beginning of 2021 on pricing. So that's a fairly significant run up here that goes away. And I actually like this next slide, and I know it's a little bit mathematical, but this is on log scale. So that's why as you go up in value, the lines get closer together, and the slope on this is just freehand. I should do a best fit, but that gives you the rate of appreciation overall. And basically that's where you'd expect it to be. So up here, you were basically having people say we were in a bubble situation where homes were overpriced, homes were selling for too much money. But conversely, now we're way below, but we're still pulling away, because remember, this line's going up, this line's not horizontal, and this line's still going down. It's going to be a little bit while before we go up and start closing this gap at all. Now we're going to look at each week's data. We're looking at the sale price to list price distribution of every property. So that's just plotted on the graph. Here you can see that 5% of the sellers got less than their asking price, and you can see the real number is somewhere around 12% of the sellers got less. And then you had some number close to just call it 10% that got their asking price, and something like 76% of the sellers were getting more than their asking price. And this was a year ago on February 7th. The reason we're comparing February 7th instead of February 11th is I compare the same weeks, and then I add 1 week at the end to bring us up from February 7th of 2023 to February 11th of 2023. When we have both arrows, you're at a plateau, red arrows up, blue arrows going down. This is the best week we ever had, which was just March 29th of this year. This is for Silicon Valley data, single family. This is the worst we ever had, which was just after World Trade Center, just the weekend after Thanksgiving, I think. And now we'll step through and show. So here's 11 months ago. So you did a fairly significant improvement. Now there was no real improvement. You can see all three are the same, which is the plateau. Now you're coming down to 8 months ago, way down, way down, way down. Now you're plateau, and it's actually almost uncanny on how close these lines are on top of one another. You can see that they're just plotting right on top of one another. But that will change in a little bit here. I called that a down week. That's definitely a down week. Way down, down, and now we're probably back to a plateau. There is a little bit of a bounce, you know. And here's the plus week. So the plus week is the dotted line sort of on top of the purple. And that's because you're adding the data from the 7th, 8th, 9th, and 10th. So you're adding 4 days out of 35 days. So it's only 10% of the days that are being added, and it really doesn't change very much. But when you do a full 7, you can start seeing that there are times when it makes a fairly dramatic change. Most of the changes when it was a whole month, so it was a whole new set of data. So here's a quick recap of Silicon Valley micro market area. So you have your DUI, and if you were just to look at this, you would think the market's absolutely on fire. But then you have to look at the magnitude of overbidding, the frequency of overbidding, which is basically a cool market price, and then the sold price, which has nothing to do with market conditions other than what the price is. Here's the DUI over time, and you can see I didn't have DUI for the Alameda County micro market areas here, but I'll have them going forward, I believe. But you can see how much redder this slide is on the 11th than if we came back to, say, the 21st. So the market is getting hotter, but that's again because the buyers have come out of the woodwork and the sellers haven't come out of the market. I don't think the market has fundamentally changed. Here's actually the numbers for the 3 counties that make up Silicon Valley as well as them all combined. I feel obligated to point it out. You can see Silicon Valley shows a 16% price appreciation, and this is over the 2020 calendar year. But if you look at each one of them, Santa Clara County has the biggest appreciation, and it's not even 7%. San Mateo County is down a little over 4%, and Alameda County is down 0.5%. And it's just how the mix happens, which is why I'm a big proponent for actual micro market data versus the media that tends to be on the Bay Area data. You know, when you're a large organization like National Association of Realtors, you know, you have to look at big things like the Bay Area. But when you're trying to understand what's happening, like in the local media, they should be talking about what's happening locally in Silicon Valley or Santa Clara County. Just my 2 cents worth. I don't expect anyone to look at here, but this is, since I think it's such a big deal, this is where the data from the first slide came from. And you can see the number of offers accepted each week. And here is your record low, and your previous record low was back here in 2008. You can see we were 2008, then we jumped up forward because of the pandemic. Then we jumped all the way up to last year, and then we jumped way back to 2007. Then we were back to last year. Unfortunately, we are in one of the slowest years, and that's the numbers to go with it. This is not comparing apples and apples because it's looking at February data, looking forward. February data is not available until basically March 8th, but what I do is I just go through midnight last night, and you can, do things like look at the inventory on here, and you're at 528. So you have basically not more inventory than you did last year, but relatively light inventory. And that's what I was talking about. There's simply not that much inventory for a buyer, which is why days of unsold inventory is so low when overbidding and everything else is not there. When you come down here to the number of sales that are happening, you're at 432, and you're not going to see any number anywhere close to that low. But you also have to remember this is only through the 11th of February, or through the 10th of February, and sales are increasing at this time of the year. So even if the market doesn't improve, this number will increase. And that's why I'm saying you can't compare apples and apples. People that want to compare apples and apples have to look back in the rearview mirror and can look at January. And in January, you can see we had sold 430, which was basically an all-time record low number of transactions. But we've already talked about that multiple times. Now what we're doing is we're looking at the 3 counties that make up Silicon Valley. And we're going to go through this fairly quickly, but we're going to look at active listings. You can see the active listings are down here. You can see the annual line coming up here. I'm trying to be consistent now, make it easier for people to read the charts. You can see inventory normally goes up fairly steeply, and it's going up fairly steeply. People are going to notice this little decline, but there's a little decline in this year. There's a bigger decline this year. So when the market's going up, it's not necessarily a straight line up. Here's the number of offers accepted. And again, you can see you've improved. And since you don't have an annual comparison, you have to go back to the previous slot, but we've already looked at that where you look at it compared to normal. But you can see all areas are following the normal pattern. You can see that they're down compared to where they are, normally are, but not down dramatically, at least not when you look at it this way. Here's your days on sold inventory, and here's the market improving. A dropping DUI is a better marketplace, but you can see that it went racing up before the holidays. So I expect it to come back down. It's not going to get down to this level. What level will level off at? Who knows? It will sellers will start coming out of the marketplace and eat up the few buyers that are available. Here's your DOM, days on market, for the 75th percentile. You can see that they're all very similar, with Alameda County actually being one of the quicker moving markets, and San Mateo County is actually the slowest. So it's just, things that you might want to observe. Median days on market, very similar. Santa Clara County looks like it came in low, followed by San Mateo, and then Alameda actually has the highest days on market and median. So it's sort of interesting just the difference there and the different data points that you look at. This is the magnitude of reduction. And what you're looking for is any patterns that don't follow one another, because then you have to question whether you have good data. When they all lay on top of one another like this, data points that match pretty well. Like back here in 2019 and 20, or 18 and 19, Santa Clara County was doing bigger reductions than the other 2 counties for whatever reason. This is the overbid magnitude. Here, Alameda County is outperforming the other 2 counties, but you can see that in general, the trend is fairly similar. You can see Alameda County really outperformed the 2 counties after the pandemic, and I believe that was associated with remote working and people now willing to live in Alameda County where it was more affordable, bringing up their demand and the price pressure. And this may disappear now that people are starting to go back to work more and more. Frequency of overbidding, again, Alameda County is the most aggressive, but following the same pattern. Here is the price point. And I made a point of it, I think it was only 2 weeks ago, where Santa Clara County was the most expensive, and it was short-lived. Last week it reversed, and it's reversed more noticeably. San Mateo County, the orange, is more expensive than Santa Clara County, the blue. Long-term, that's the order you'd expect it to be. I think there was 1 week where it was more expensive. I think there was a $20,000 gap with San Mateo more expensive than the next week, which might have been just 2 weeks ago. Santa Clara County was $20,000 more expensive. Last week it reversed, and this week it reversed and spread the difference. But what the horizontal lines do is let you come back and start saying, okay, we're back here to the pricing we were at the beginning of 2018. Now that was a peak before we went down. So the recent peak would have been just before the pandemic. So basically all 3 counties very clearly lost all the run up that we've had since the shelter-in-place pandemic. So it was just a run up and a run down. I don't think anyone expected that, but that's what ended up happening. Here's the sold price. You can see it just over time. This is on log scale. minus the horizontal lines. This is the percent appreciation. So this is over and you can see I have it labeled here from April 1st, 2015 through December 31st, 2015. The last 9 months of 2015, and you can see that basically in this period of time, the pricing was very flat. So it was a good time to get the median price. And then you just compare it. The county that's doing the worst is San Mateo County, followed by Alameda County, and Santa Clara County has outperformed the other two counties. So we've appreciated more. With that, we'll change from Silicon Valley, and I do have micro market data offline. These are the different areas that are available. We'll now focus on the Greater Bay Area. The Greater Bay Area includes 13 counties, the 3 in Silicon Valley plus 10 others, being San Francisco, Marin, North Bay of Sonoma, Napa, Solano, and Contra Costa, Central Valley of San Joaquin, Sacramento, and the coast of Santa Cruz and Monterey. Gives you a concept of the bigger area, what's happening. The data is gathered on March the 1st and goes back in the rearview mirror 35 days, no matter what those 35 days are. And then I increment to March 8th and look back 35 days. That's why we have the data of February 7th, not February 11th. February 7th is a multiple of 7 after March 1st. And then when you get to, I think it's February 22nd, you jump forward to March 1st, regardless of whether it's a leap year or not, and then you look in the rearview mirror. Here are your 13 counties. I did a subtotal for Silicon Valley. I did a subtotal for the Bay Area, and there was one number on this chart that was stuck out as wrong for me. And if you add up these three numbers, they don't add up. You know, you got 10, you're 11, and then if you just take your 3 plus 2 plus 5 is 0, and that's a 9. Something wrong here. I think it's pretty minor. I don't think it impacts the data. This number here appears to be correct. I think there's just a typo somewhere in my numbers that I didn't catch, so I apologize for that. But it does make me suspicious of my numbers all across the board, but I think it's probably one data point versus all of them. And it's probably, I think it's the sum of Silicon Valley. So the 3 counties individual are all good, but I don't trust this offers accepted because I know it doesn't equal. But then you have your San Francisco, Marin. I broke them out by my groups. Then you have the North Bay. That makes up the Bay Area, the 9 counties that touch the Bay. Then you have the Central Valley and the Central Coast. That gives you a snapshot overall. This is sort of all the key benchmarks that I've been following. Here is the 5 areas in graphical form so you can see over time. You can see inventories down. You can come back and compare it to year patterns for the same. This is number of offers. They're all performing the same. They're all shooting up at this time of the year. That's what they do. You just got to go back and look at the previous years. You can see the huge impact the pandemic shutdown had on us. Here's the number of closed transactions, very similar to the number of offers, just delayed by 5 weeks. And you can see that it's just barely starting to turn here, where the number of offers has been going up for a while. Here's your days of unsold inventory, very close together, all plummeting down. You can see that Santa Clara County, Silicon Valley, the 3 have stuck out lower than the other 4 areas. The other 4 areas are pretty close together, which is one of the reasons I focus on Silicon Valley. Here's median time on markets. So you can see Silicon Valley is on the bottom of it. The other 4 groups are pretty close together. Same with days on market on the 75th percentile. Here you can see that the Central Valley caught up a little bit right after the pandemic time frame, and I think that was people moving out to Mountain House to get their McMansion and commute in occasionally. Here's your overbidding. This is the price reduction, not overbidding, sorry. So this is very similar, and it just shows sellers are resistant to reduce their price. It's again the 10% of the sellers that are taking the biggest price reduction. What is their price reduction? So when it's flat like this at 100%, your sellers that were taking the biggest reduction weren't taking a reduction, but then they got all the way down here to taking a 15% reduction on the Central Coast, and most of the areas were closer to 12%. And now you can see Silicon Valley's up here, and it's somewhere around 92.5%. Here's the list price to original list price at the time the offer is accepted. So you can see see Santa Clara County, Silicon Valley is taking the smallest reductions. The other counties are pretty close together and following the same pattern. So you can really start seeing when you see all these graphs the huge cyclic nature of the real estate market. Here is the correction we had last year where, this is basically April, May timeframe, and we just basically fell off a cliff. We did a little bit of a plateau. I think it was the month of July, and then we came down a little bit, and now we're actually turning around and improving a little bit, and we'll probably have some normal cycle going forward. Here's the frequency of overbidding, and look at the drop here in the Central Coast area. It came down and then just boom, it's dropped, and it looks like it's finally turning, but it's had this second wind, or actually the third wind, because there was a little plateau there, still going down, or was still going down, and one of the lowest. It's down to the point where overbidding is down at less than 20% of the sellers are getting overbid. This is the total appreciation. Again, the tail end of 2015. You can see San Mateo County has way underperformed all the others, and you can also see that the Central Valley is way overperformed. And again, I think that's the recent interest in Central Valley with remote working, and the homes that are being built in Mountain House are more expensive than the homes of the Central Valley itself. Here's the smallest amounts of overbids. So this is what's the overbidding of the smallest 10%. So you take the overbidding that is the least, 10%, so most likely to be under 100%, plot that out, and again plot that, and you can see that the Central Coast is underperforming the other areas. The overbid median, so this is what the typical overbid is, and the reason I don't like this particular data, you can see there's a lot of time when the data's at 100%. It got above 100% when we were rocking and rolling, and now we're below, and we may get back up to 100%. This is the largest overbid, so this gives you an idea of what the seller that's taking the most overbid is. And here in the underperforming counties, it's somewhere around 102.5%. Silicon Valley is somewhere around 107.5%, and San Mateo County, San Francisco Marin, San Francisco Marin is somewhere around 115%. So right now, sellers are getting 15% more. The 10% of the sellers are getting the most overbidding. With that, I am done. I do have the handout out. I got it up early today, believe it or not. So you type in the green root URL to join this meeting Saturday morning live. You add in H for handout, the year 2023, the month 02, the day 11, and that will give you 58-page PowerPoint presentation, what I basically just went through in a PDF format. To get to any episode, you type in the year, month, date code. To join live, you just type in the green root URL, and I'm available if anyone's got any questions for me. I'm not seeing any unmuted mics, so I'll call it a week. Thanks for joining. See everybody next week. Take care. Bye.